Warren Buffett, the king of value investing, once mentioned that many Americans are an existent nightmare rather than the American dream. It is because the most important thing we need to understand about investing is that it involves putting the money we invest in something at risk in exchange for a potential reward. In this video, I will uncover the 7 types of investments you must have according to the legendary investor Warren Buffett. Uncorrelated assets. Have you ever noticed how rich men tend to collect watches and wealthy women have dressing rooms filled with luxury bags? If more of them were to show up on the market, people would jump at the opportunity to snatch them. Rich people focus on high-demand products with a limited supply, but most do not know this. Uncorrelated assets could include investing in things like wine, luxury, watches, or antiques. According to Warren Buffett, proper diversification can only be achieved by simultaneously investing in multiple uncorrelated asset classes, from stocks to real estate to bonds to commodities like gold. If you are not diversifying across different classes, you are not doing anything to reduce your risk. Some people do not like the idea of diversifying across asset classes because they are afraid that diluting a 100% stock portfolio with other assets will reduce their returns. But what these individuals don't quite understand is that in investing, you should not be focusing on returns in a vacuum. You should be focusing on returns per unit of risk. Oil stocks. There are 2 core factors at play when Buffett is investing in oil stocks, such as Occidental and Chevron. Firstly, he probably has a view that oil prices stay higher for longer than most people anticipate. And secondly, he likes the capital allocation taking place at these companies. Limited capital expenditure for growth and exploration, and a lot of cash being funneled back towards shareholders through debt, repayments, dividends, and share buybacks. To an extent, that second capital allocation reinforces the first point of oil prices. Staying high if every company is doing a bunch of sheer buybacks and paying dividends, and no one is spending money on looking for new oil, is another kind of significant constraint over the long term on oil supply. It is also important to reiterate that Warren Buffett's movements in the oil stocks do not represent his prediction of where oil prices are moving in the short term. Most people saw him buy into the oil companies and took this as a big bet on high oil prices moving forward. Warren Buffett once said, "If we were in an oil stock, it is because we think it offers a lot of value at this price. But it does not mean that we think the price of oil is going up. If we thought oil was rising, we could buy oil futures." So do not take his moves in oil companies as a sign of oil prices. To cut a long story short, Buffett looked into the company and was impressed with the management. He noted that the CEO was doing what Buffett would do with the company. He jumped in as he thought the business was high quality and a better place to put his money than simply keeping it in cash. Also worth noting, the business is paying solid dividends and returning value to continuing shareholders via shared buybacks. Treasury Bonds. It is considered the risk-free rate or the risk-free investment out there, and that is because it is backed by the full faith and credit of the United States government, which would lead to a discussion about what happens if the government defaults. Treasury bills are not taxable by state and local governments compared to a high-yield savings account or a certificate of deposit. You can effectively increase your rate of return by not paying taxes to your state or local government. Treasury bills are very liquid. It is like having cash. There is such a wide open market for treasury bills that you can sell these almost instantaneously to retrieve your cash now, which may come at a loss. Blue chip art. Good art is one of the best ways to protect yourself during recessions. Blue chip art is scarce and demanded by people. It is the other way around that rich people get even richer during recessions. The art market has been consistently outperforming the S&P 500, real estate, or gold for the past 25 years. And not only that, art is a good performer even in an inflationary period. Why should you consider investing in blue-chip artwork? Well, for starters, it is over $1 trillion industry and growing. It is a niche and sophisticated asset class of investing in art. It is far from investing in bonds, stocks, or even crypto. because it is a unique and sophisticated asset class. One of the famous but also mysterious investments for the ultra-wealthy is fine art luxury multi-million-dollar works quietly appearing in mansions and yachts via mysterious dealers. A large part of the $1 trillion plus art market is invisible if you are not in the 1%. You might ask how it works. Well, that is where Masterworks comes in. Masterworks is a platform that allows everyone to invest in high-end art. Instead of buying the painting on your own, they break the ownership of a piece into shares the same way a company does with stocks, and you can buy shares in it and sell or buy these shares at any time. Fractional ownership is one of the biggest trends. The art space is inspiring, especially considering there is no minimum investment amount, and the platform also allows you to learn about the trends in the art space and see just how profitable the art market can be. Investing in emerging markets. Brazil, Russia, India, China, Cambodia, Indonesia, Vietnam, Egypt, Turkey, and South Africa are emerging markets expected to rise in prominence over the coming years. Emerging countries mean their transition is already in progress. Most of these countries have already seen an uptick in real estate prices in the last decade. Where the money is right now is in the countries bordering these emerging geos. Let's take Turkey, for example. You do not want to go south because the situation is unstable. But you can go north and find the country of Georgia. Did you know that you could buy a one-bedroom apartment by the seaside for $35,000? They are building 5-star hotels in Belize where you can buy hotel rooms for under $100,000 and get a 12% per year yield. This is just an example. Take Thailand or Indonesia. People know of Phuket or Bali, but there are other parts of the countries where investment opportunities are still cheap. In 1959, someone bought a large property on a cliff for $10,000. In the Tamarama neighborhood in Australia, a beautiful property overlooking the bay, adjusted for inflation, that $10,000 would be the equivalent of $300,000 today. But last Wednesday, the Tamarama house just sold for $47 million, setting an Australian record. Back then, the Australian coast was an emerging part of the world, in keeping with the real estate trend. Side business. Investing in a business as a passive investor can provide a source of income without working in the industry actively. Warren Buffett himself is a prominent investor in successful businesses. A business can be a great source of passive income if set up correctly. The idea behind building an inactive revenue. It is building a system that can run without requiring constant attention from you as the owner. This means that you must start a scalable business capable of generating revenue without continuous involvement. This can include ebooks, online courses, and other digital products that can be sold online. Once you create these products, you can continue to sell them, repeatedly generating continuous revenue. But what if you are not a business owner or do not have the time or resources to start a business? Well, there is a solution to that. Why not invest in other people's companies? Overall, building inactive earnings in business requires commitment and patience. Still, it is a great way to create a sustainable source of income that can provide financial stability for years to come. By creating a scalable, efficient, and automated business, you can start to earn passively while freeing up your time to focus on other things. Index funds. Since 1965, Warren Buffett, the world's widely respected investor, has been laser-focused on buying individual stocks and trying to beat the market to benefit the shareholders of Berkshire Hathaway. He has done that successfully with an average annual return of 20% versus the S&P 500 rough 10%. But one thing that is interesting about Warren is that he does not recommend most people do what he does. He instead suggests that most people subscribe to passive investing. What is an index fund? An index fund is just a group of investments you can invest your money into, and then you will own a small percentage of the entire thing. Index funds track the market as a whole, rather than one specific stock. They have low fees. That is because indexes are very simple to put together and manage. There is not much overhead, and all those savings get passed on to you as the investor. It is also known as a passively managed fund. You are buying into an entire portfolio of stocks that automatically gets balanced and adjusted over time. Even if you have 20 individual stocks in your portfolio, if one of these goes down and fails, you can end up losing a lot of money. On the other hand, if you go and buy the entire S&P 500 index funds, you have 500 different stocks and different companies that weigh your overall return. And if even one of these fails, it does not matter because you have 499 others to boost you up. Most investors out there will make more money investing in an index fund than they would investing in individual stocks on their own. Several studies have shown that over 92 to 95% of portfolio managers could not outperform the market index over 15 years. A big reason for that is that many investors tend to trade emotionally and panic when the market drops, then try to time the markets or jump in stock as it is going up for fear of missing out. It is because of that they usually correlate to much lower than the average returns. To widen your financial wisdom, click the recommended video and remember to subscribe, like, and comment with your thoughts.